Welcome back to the Neuro Finance Masterclass. Today, on day 112, we build the digital cash cows of the crypto universe. I'm Ibrahim, and today we are putting on our risk manager hats. We are moving way beyond just holding assets. We're stepping right into the realm of high-velocity yield engineering. We're going to master the engines of crypto passive income. And honestly, more importantly, we're going to learn exactly how to survive the brutal math that powers it all.
Right, let's take a really quick look at today's strategic syllabus. We'll start with 1, the income philosophy bridge, then 2, native staking as an inflation shield, 3 is LP and impermanent loss, 4 is smart risks where code is law, and finally 5, the daily yield audit.
All right, section 1, the income philosophy bridge, TradFi versus DeFi. Before we even think about looking at a single yield percentage, we really need to align our mindset here. My core philosophy in this masterclass is pretty simple, actually. Digital tokens, they are not meant to just sit idle. They are raw capital infrastructure. If a token isn't actively generating yield for you, well, it's essentially losing purchasing power. It literally has to be actively working for you. Just yesterday on day 111, we architected a continuous cash salary using traditional stock dividends, right? Well, today, we're bridging that exact same income philosophy right into the decentralized crypto universe. Traditional dividends, they give you this slow, steady hum. But crypto passive income, that is high-velocity yield engineering. It definitely demands a bit more attention, for sure, but it unlocks just a completely different tier of capital efficiency.
Moving on to section 2, native staking, inflation shield, the network tax.
So the single biggest mistake we see amateurs make is buying tokens and just leaving them sitting idle in a wallet. Just crossing their fingers, desperately hoping the fiat price magically goes up. But a true architect, they build an inflation protection shield, which actually brings us to our absolute safest baseline for your crypto yield engine, and that's native staking, or dual staking. In proof-of-stake blockchains, so think Ethereum or Solana, you actually provide security by locking up your tokens as collateral. And in exchange for that, the blockchain literally prints new tokens and hands them to you alongside a nice little cut of the network transaction fees. Think about it like this. If a network has an internal token inflation rate of, say, 5%, and you aren't staking, your share of the network is actively being diluted. Staking basically allows you to automatically capture your fair share of that global network tax instead of just bleeding value. Let's jump into section 3, LP and impermanent loss, entering the AMM arena.
Okay, so native staking is the baseline, but what if you want to hunt for some higher yields? Well, to do that, we have to step into the automated market maker arena, using platforms like Uniswap or Orca. You basically become a liquidity provider, meaning you deposit an equal value of 2 paired tokens, say Ethereum and USDT, into a smart contract pool so that traders can seamlessly swap between them. And the pool, it pays you a percentage of every single trading fee. Sounds pretty amazing, right? Well, let me put my risk manager hat firmly on right here. This arena carries a very sharp, very hidden mathematical trap called impermanent loss, or Geçici Zarar. You really need to pay incredibly close attention to this. It happens when the price ratio of your 2 deposited tokens diverges drastically from the exact moment you put them in. When this divergence happens, the smart contract automatically rebalances your assets, which can literally erase all those trading fee profits you were just getting so excited about.
And the math that's actually running these liquidity pools, it's governed by a very simple, completely unbreakable formula. X times Y equals K. Now, it looks totally innocent on the surface, but I'm telling you, this formula is absolutely ruthless. It does not care about your personal portfolio goals. It only cares about one thing, keeping the pool perfectly balanced according to this exact equation.
Let's actually walk through how this can build into a total disaster for the unprepared. Step 1. The price ratio diverges. Let's say your Ethereum suddenly shoots up in value while your USDT, being a stablecoin, just stays completely flat. Right. Then step 2 kicks in. To maintain that X times Y equals K formula we just talked about, the smart contract actually forces the pool to automatically sell your outperforming token. Step 3. It then uses those funds to buy more of the underperforming token. Think about that for a second. It is literally selling your winners to buy your losers. And the real kicker is step 4. If you get spooked by this and decide to withdraw your funds during this heavy divergence, well, that temporary loss, it becomes mathematically permanent. All right, section 4, smart risks. Code is law, defending the wall.
And guys, this is exactly why we have to pivot to defense right now. Back on day 100, we talked a lot about traditional banks.
If something goes wrong there, you can usually rely on some form of emergency government insurance to bail you out. But in DeFi, code is law. There is absolutely no emergency insurance hotline you can call if a smart contract gets exploited. So I really need to drop the hammer right here. When you're out there browsing liquidity pools and you see a flashing spectacular number like, say, 150% APY, beware. Honestly, this is almost always a total financial mirage. That kind of number screams extreme underlying token volatility, massive impermanent loss risk, or maybe even an unaudited, fragile smart contract that is just ripe for a flash loan exploit or a classic rug pull. You really must make this your absolute mantra going forward. An architect never sacrifices their principal capital for high superficial APYs. Capital preservation always comes before chasing extreme yields. I mean, you simply cannot compound your wealth if your principal gets completely wiped out in some shady smart contract. We never, ever risk 100% of our principal just to chase a temporary double-digit thrill. It's just not worth it.
Which brings us to our final section, Section 5, the daily yield audit, a cognitive task. So, we've covered the philosophy, we've looked at the baseline yields, the hidden mathematical traps, and of course, the absolute laws of smart contract risk. Now, let's actually turn all of this into an actionable strategy to actively shield your neurofitness from catastrophic capital destruction. All right, grab a pen or open up your tracker app. First, I want you to go through your portfolio and identify if any of your long-term core tokens actually support native staking. Second, look up their current network staking yields and lockup parameters. Use verified data aggregators for this, like Staking Rewards or DeFi Llama. Third, if you are feeling brave enough to explore an LP pool, please do not go in blind. Use a free LP calculator online and model a 15% price divergence just to see exactly what your impermanent loss would be in that scenario. Finally, take all that data and build a secure, cash-generating staking matrix. We really need to stop treating crypto like a speculative betting slip. You have to respect the code risks.
And that brings us to the ultimate question for Phase 2. I want you to look at your portfolio today. Are you going to let your hard-earned capital just sit there, idle, and dilute away to network inflation? Or will you take control, master the brutal math of the code, and build a truly resilient digital yield machine? Look, the tools are right in front of you. It's time to rule the cycle. Thanks for joining us today, and we'll see you in the next explainer.